Good evening, everyone. Welcome to today's webinar on mid-year's outlook. My name is Tuya, and I'm from the digital sales team at Saxo Market Singapore, and your host for tonight's webinar. We have with us here today Candice, who is the Associate Director of Research from SGX, and she will be sharing with you on the drivers of the SG market. So hopefully this can give our audience some ideas and inspirations for the second half of the year. So before we begin, this is the disclaimer that we have for that today's content that we'll be sharing with you is just for your general knowledge and does not contain any financial advice. So please only trade or invest once you have read and understood the risk that's involved around the financial instrument. So our webinar will roughly take about 45 minutes, and this is the agenda for today's session. I will start off with a short demonstration of our Saxo Trader Go platform. And we also do have some giveaways for this webinar, which we'll be giving them away at the end of this session. And from then on, our guest speaker, Candice, will take over to share more on today's main topic, mid-year outlook, drivers of the SG markets. And after which, we will follow it up with a short Q&A session. So should you have any questions along the way, do feel free to post them in the chat, and I'll be verbalizing them, a few selected ones, for Candice to address them during the session. And last but not least, we will end off with today's webinar with the promo code to redeem the free gifts. So make sure you stay tuned till the end. So let us begin with our award-winning platform, Saxo Trader Go. To access the platform, you can go to the URL saxotrader.com, or you can simply log in from our homepage, home.saxo. And Saxo Trader Go is available on both web and mobile app. So once you have logged in, this is the new screen layout which you will see. We have now included a new overhead called Spotlight, which houses the highlighted features and other essential tools that will help you to build your unique and diverse portfolio. And we do recommend our clients to spend some time exploring this new tab that we have, as it will really is very relevant in helping you to kickstart your journey at Saxo platform seamlessly. So, say for example, you have any instruments in mind by name, then you may use this instrument search at the top right. So, for example, if you're looking at Nikko AM ETF, you can simply click on the result, and what this does is that it will bring you to the product overview page where you'll be able to view this instrument in full detail. Alternatively, you can also choose to use our screener function, where you can just edit the filter list accordingly. You can set it as ETFs, you can set it according to the Singapore country, and you'll be able to find the different ETFs that we have according to your filter list. So that's it for this today's short demonstration of our platform. And going back to the deck, next we have our giveaways. So here's a sneak peek of what you can redeem at the end of this session. So do make sure you stick around with us until the end to retrieve the promo code, because only the first 10 can walk away with all these goodies. Yeah. From now on, I would like to hand over the webinar to Candice to share with us more on today's topic. Over to you, Candice.
Thanks, Tuya. I hope my screen is showing. Right, that would be my slideshow. Okay, good. Hi, everyone. Thanks for joining us today. I'm from Singapore Exchange. I'm the part of the research team at the Singapore Exchange. So today, I think we'll start off with covering some of the highlights of the market this year so far, and also looking deeper down into the year, which are some of the I would say highlights that we should then be looking out for. But again, as always, before we begin, there's always a disclaimer, same as the previous disclaimers shown. Want to point out that the presentation is meant for merely informative, not providing any investment advice. So if you do want to do your own research, make your own investment decisions based on your own risk appetite, that's the most important. So with that, let's get started. First of all, a quick recap of what happened this year. If you look at the Singapore benchmark, right, this year, it was ranked. So following from last year, SCI was the strongest benchmark in 2022 across Asia and Asia Pacific. But this year, slightly, dropped the leaderboard a little bit with some movements across the region, and a lot of these are tied to the regional economic developments in China and the US. So some of these movements, we've seen that SDI ended the first half of the year still in the green, but gaining just marginally by about 1.2%. But still, if you look at the performance since the end of 2019, which is actually the before the start of COVID, STI is still leading the FTSE APAC and FTSE ASEAN indices with a total return of 16%, 15.5%, which is almost double that of the APAC ex Japan index and the APAC index. Another very key indicator or metric that the investors look at for the Singapore market is fund flows. Overall, we've seen that the net institutions, meaning that institutional investors have seen a net outflow of over 2 billion Singapore dollars. And that has extended to 2.8 billion if we just close off as of the end of last week. On the other hand, net retail has seen an inflow of about 2 billion Sing dollars at the end of last week. For those who are not familiar with the concept of fund flows, right? This is actually an indicative flow. I mean, I'll just take a bit of one minute or so to explain the concept over here. It is an indicative flow on an aggregate level from retail participants and institutional participants. When we say it is a net amount, it means that we are minusing, meaning that we take the net total buy amount from, say, the retail segment or the institutional segment, we minus the corresponding sell amount so that we get a net amount of the flows. Aside from institutional and retail, right, there's also another segment from what we call market makers and active traders. We don't report, we usually don't look at this segment. Rather, this segment is the one that kind of bridges the difference between net institutional and net retail flows, right? So I hope this gives a sense. The flows information is all available publicly on the SGX website for those interested to kind of follow this. So if we're coming back to the data itself, right? First half of the year, there are some stocks that saw high institutional flows. Sembcorp Industries, Genting Singapore, Singapore Airlines, they had the highest net institutional inflows. Aligned, for example, Genting and SIA definitely aligned with the reopening theme that we have been seeing and also going into next year. So for example, Changi Airport has seen record flows in June, and they're expecting that to continue into next year, especially with the opening of China. SIA also have seen record revenues this first quarter, I think, of the year that they reported. On the other hand, DBS UOB, Singtel saw the highest net outflows in line with some of the interest rates movements and also along with global markets that we have seen. So this is flows, meaning that the net flows from different types of investors. But in terms of price performance, that's another probably a key indicator that many are looking for. Top stocks this year that bucked the trend because SDI only gained about 1.2%, right? But actually, there are stocks which actually saw huge increases in price performance within the SDI, which is Sembcorp Industries and Keppel. I think the third in line is SIA. So if you look at the three stocks, or rather the top two stocks this year, you can see that one half, Keppel has 42% gains. Sembcorp is about 72% gains. Interestingly, both of them, there's some similarities, which is why we're talking about these two stocks. Interestingly, they have been both what we call pursuing strategic transformation reviews of their business lines and pivoting towards sustainability, renewables. So if you look at Keppel first, right? For those of you who might be familiar, Keppel has many areas of business, but it has been embarking on this transformation plan, what it called Division 2030. So what it's trying to do is establishing itself as a leader in the energy and environmental infrastructure services industry. Most notably, the first quarter business update, right? I'm just talking about first quarter because the first half is not out available yet. And coincidentally, Keppel is actually announcing first half results tomorrow. So something to look out for. But if you look back into the first quarter results that he reported previously, its renewable energy portfolio has grown from 2.6 gigawatts at the end of 2022 to about 2.8 gigawatts at the end of March first quarter. And if you look at the revenue itself as well, the group revenue went up 9% year on year. Majority of that revenue comes from the energy and environment business, taking up 70% of that revenue. It also has other business lines. Connectivity is one, it's about 15% of revenue. Urban development is about 10%, and then the remaining goes to asset management. So on the other hand, or rather similarly, Sembcorp Industries, right? Of course, we know about the recent merger of Sembmarine into Keppel, right, to become Seatrium. Also another top traded stock this year. But for Sembcorp itself, it's also been pivoting to renewables. It's transforming its portfolio from what we call brown to green, right? So it's talking about sustainable solutions. And this segment, right, is on track to make up about 70% of Sembcorp's net profit by 2025. Some key drivers for them is, of course, number one, more renewables, more sustainable urban developments, and lower carbon emissions. So in terms of the renewables, right, it did mention that for now, they have about 8.3 gigawatts of gross installed renewable energy capacity as the end of 2022. And it is on track, right, to meet its target by 2025, which is to have 10 gigawatts of renewable capacity. Bit of background on renewable energy. Of course, I'm also not an expert, but just giving us a context of some of the terms that we might have seen in reports. Unlike conventional energy, right? Renewable energy don't generate electricity 24/7. The power generation depends on what they call plant load factor (PLF), meaning that, for example, if you look at solar energy, right, that would depend on the irradiance level, meaning the solar power that it receives throughout the day. It's not always sunny. The wind power plants, they need to look at the wind resources for the day. So they depend on the load factor. So putting that into context, Sembcorp noted that for its solar assets in Singapore, its plant load factor is between 13 to 15% last year. If you look at Singapore, our HDB flats, right, assuming average consumption, putting that into context, meaning that every 1 gigawatt of power could power over 270,000 four-room HDB flats in a year. So this is what we call, in putting into context, right, because Sembcorp has about 8 gigawatts of capacity right now. And of course, looking at profits or performance, financial performance, Sembcorp net profit is up 200% to 848 million Sing dollars last year. Among its highlights from last year, some of its strategic collaborations on newer initiatives includes the progress into hydrogen and other decarbonization efforts. Of course, also reporting first half soon, which is scheduled for early next week, I believe. Yeah. So these are the top 2 performing stocks within the SDI this year. Moving on to the flows, right? Back to the overall, I would say the overall Singapore market. Previously, we talked a lot about institutional flows. Another key flow is also the retail flow, meaning that how is the fund flows going from the retail investors? Which are the sectors that the flows are going into? First half this year, it's retail has seen a net inflow of 1.5 billion Sing dollars compared to about 950 million inflows comparatively to the first half of last year. In terms of the sectors that we are seeing, financials, REITs, technology continue to be the top net buy sectors for this first half of the year and also last year. Financial sector, we have seen that it's largely driven by the three banks here in Singapore. All of them actually reported record FY22 net profits. Also that technology, another one, it's the strongest sector in the global markets this year so far, and also across the APEC region. But of course, Singapore tech companies are mostly hardware, semicon. They are much hinged on electronics. And of course, if you look at the macro environment over here, electronics has been in contraction for the better half of the year. So this is I would say, tech companies over here in Singapore has been pretty cautious so far. Yeah. Another one to look at, of course, three sectors over here. REITs is another one. Really mature market. REITs, retail has been not buying REITs this year and also the first half of last year, if you look at the comparative same period. So I think the next slide I have is a little bit more on the REITs segment, right? So like I said, REITs this year, they have been, retail investors has been net buying. If you look at the by sub-segments, right? So REITs in Singapore are divided into 7 sub-segments, meaning that these REITs have assets that is in this particular industries or segments, meaning that they have probably office buildings or industrial buildings, logistics buildings, maybe hospitals, healthcare, retail shopping malls. Many of the shopping malls we know in Singapore are actually owned by REITs. Hospitality, hotels, student accommodations as well. Specialized REITs are data center REITs. We have 2 data center REITs listed here in Singapore. So across the REITs this year, retail flows this year, which is the blue colored bars, green is for last year. Retail has been diversified REITs, highest net buy by retail investors this year. Last year, highest net buy into industrials. We have seen generally that during the COVID period, the performance of industrial REITs have been the better ones because of stability. During COVID, hospitality REITs has fell. But recently, more and more, we have seen that the flows into diversified REITs have also increased, and increasingly there are more REITs becoming diversified REITs. What it means is that basically these REITs are just buying or owning assets not from just one single sector. They actually own multiple, meaning that I can have shopping malls, I can have offices, right? So they have a mixture of this. One of the key drivers we have seen some of the REITs actually did announce and explained why is to have that stability in revenue, in rental revenue, and that is especially so and prominent to help them cushion some of the headwinds which we have seen during COVID. Yeah, so this is increasingly why. In terms of performance, best performing REIT this year has been Keppel DC REIT. This is the pure play data center REIT. They have some assets in Singapore, but also across the region and the world. And you will see that Keppel DC REIT was also the best performing REIT back in 2021. It saw a bit of correction last year, but this year it has been continuing to perform up 25% in the first half. And interestingly, from what we have seen, right, and I'll just share a little bit more, is that Keppel DC REIT, they just announced results yesterday. Gross revenue grew by about 3.6% year on year. And they said, and they said that the higher revenue was contributed by the acquisition of data centers in China recently. Interestingly, is also that their net profit income in correspondingly also increased about 3.3% this year. They are still optimistic about the growth of data centers. Demand is still saying that it's still robust with the growth of things like AI, cloud computing. So this is what the REIT is optimistic about. Yeah. Okay. I think I have a little bit of more time. We can look at the maybe I touch a little bit more on the next half of the year. Some there have been some movements in the global markets, right? Economic data driving forces. Then a lot of questions that we have been asked is that then how is Singapore performing in this environment? Why should investors still look at Singapore? Is it still attractive? I think from what to make it easier to understand, kind of summarized it into 5 key reasons of why investors should start or still remain looking at the Singapore market. And I think I touched a little bit on the performance just now, in terms of the stability, right, and the performance and the long-term returns. And of course, this resilience, if you link it back to the Singapore, there is also that stability of Singapore, right? Our stable political framework is an international financial hub, and also, I would say, global business efficiency. People like to do business over here because of the stability. In terms of GDP performance for Singapore, last year 3.6% GDP growth. First quarter of this year contracted by 0.4%, which is why the second quarter GDP was something that many of the analysts, investors was focused on, because if we get 2 quarters of contraction, then that is what we call a technical recession. So luckily, second quarter as advanced estimate beat expectations with a 0.7% expansion. Recently, IMF also reiterated this month that Asia is still poised to be driving majority of the global economic growth this year, and of course, this is led by China, and especially with the reopening, right? Asia is expected, if I remember wrongly, if I remember correctly, Asia is expected to contribute about 70% of global growth this year, and the growth in APAC is also forecasted to accelerate this year. So there's something to look forward to. I think, but one driver of the Singapore market that we should look into is because when we look at the performance, right, of Singapore, we usually look at the benchmark, which is STI. To understand the STI, you can see 45% of the STI is actually taken up by the 3 banks, DBS, OCBC, UOB. Like I said, these 3 banks have seen record profits this year, last year, and into first quarter. They are all reporting soon in early August. So something that we need to look out for as well, because these are the key drivers of the index. First quarter net profit also record. ROEs also has been pretty high at the 14-15% range for the 3 banks. What we have seen is also their net interest margin, meaning that their net interest income, meaning that the income that they get from interest revenue, and that is really highly correlated with interest rates globally, has reached a peak as well in the first quarter. Analysts have expectations that probably maybe that the interest income might have peaked, that it is now at the top peak already, meaning that perhaps it's going to drop a little bit, which is why there's expectations and people are looking forward to see what is the first half report for the 3 banks. And of course, given interest rates expectations right now that is coming closing off to the end of the rate hike. So something that we should be looking at as well. Another key driver of the Singapore market, besides interest rates, is also been currency. Okay, I wouldn't say driver, but a important highlight, I would say, that people look at, because Singapore currency has been pretty stable. It has been appreciating against the USD for majority of this year. And of course, Singapore is also one of the most open economies in the world. So similarly, the Singapore stock market is also a very international stock market. If you look at, put it into context, right? We have looked at the 500 over Singapore stocks that was actively traded this year. Only 140 of them has reported majority of their revenue to Singapore. The rest actually only report about 50% of their revenue to Singapore, which is actually pretty parallel to, I would say, the Singapore economy as well. And a lot of the stocks actually have exposure to ASEAN as well. And I would say that from the exposure to ASEAN is the top region, of course, from Singapore, listed stocks. Second region is China. About 80 to 100 stocks report more than half their revenue to China, which is pretty significant at this stage. Another two factors is also the dividend yields and valuations, right? STI has always been one of the highest, I would say the highest, offers the highest dividend yield globally for the longest time, even up till now, if you look at the comparison on the slide. In terms of valuations, it's also at about 12 times PE, forward PE. PB is trading near historical average. And also, if you look at the comparing rate to the global indices, so undemanding valuations at this point, I would say. Yeah, I think this is the end of my slide. I know just now it's about 7:30. I'm seeing some questions coming through, so maybe we'll save some time for the questions instead, and I can address some of this as we answer the questions.
Yep. Thank you, Candice, for your kind sharings and insights today. So actually, yes, we do have quite a lot of questions from the audience. So allow me to, verbalize a few of the selected ones. Okay, so the first question we have is, how do I know what stock to look into to invest, and what kind of alternatives are there available, like the ETFs?
Actually, there's a good question. One of the struggles, I would say, for a investor many a time is to looking at the right stock to invest in, or to even get ideas for stocks. I think just now, I think Tuya, you also shared the you used Nickel AM ETF as an example, right? So of course, naturally, for somebody who don't know where to start off, ETF is definitely the perhaps a starting point for everyone. SGX has many listed ETFs. STI ETF is definitely one. Besides the STI ETF, some of the top traded ETFs this year are also, of course, gold. We have a few gold ETFs in both USD and SGD. And there's also other types of ETFs like tech ETFs that give exposure to Hang Seng Tech ETF. There's also ETFs that gives exposure to Chinese equities, US equities, even the S&P 500. So a lot of choices over there as well. But just to share a little bit, right, on the what we have seen on ETFs so far, which is also pretty interesting, is that the turnover for ETFs has seen an increase. Also, have seen a decrease from in first half of the year. But in terms of the asset class, a few ETF sectors or segments that we have seen growth. One is gold. There's more turnover for gold ETF. Another one is Asian REITs as well. We have seen increase in turnover, and interestingly, it's also Chinese equities. And this is actually dominated by the Lion. The full name should be Lion OCBC Securities Hang Seng Tech ETF, which tracks the Hang Seng Tech index in Hong Kong. This has the highest first half turnover so far this year, and if you look at it, this is actually closely related to the performance of the Hang Seng Tech index as well. I think June was a key shopping festival, 618 in China. And I think in June itself, it gained about 7 to 8%, and doubling that of the main Hang Seng index. And if you look at that, and also I think outperforming the Nasdaq 100 index as well. And I think middle of this month, the Hang Seng Tech also, or the China tech stocks in general, have seen a huge, I would say, one of the best weeks of the year so far, because of optimism that the crackdown on the tech stocks is coming to an end, with the Chinese premier meeting some of the tech giants representative over this month. So I think there's optimism there, definitely. So some of the examples I've mentioned, right, are all equities ETF. But if you're interested, right, there's also bond ETF as well. And interestingly, we have here listed the world's largest Chinese pure bond ETF. Yeah, so that is also one that we have seen improve investor sentiments and turnover recently. Yeah. So I think a lot of choices to look at. And of course, I think if you want to see the full list of listed bond or ETFs, I think Tuya have showed the screener just now. I think there's a way to screen for this Singapore listed ETFs, right? Yeah.
Yep. Hopefully, this will give our audience some alternatives to consider. Maybe we can move on to the second question too. It's about Singapore. That Singapore just avoided a technical recession, and what is the business outlook, and also which sectors are likely to perform badly. If you could take it over from there.
Okay. Sorry, the sectors, right, and the GDP, right? Yeah, I touched a little bit on the GDP just now. I think before the GDP, Singapore's advanced estimates came, there's, I think analysts didn't have too much expectations on the GDP performance. If you look at Bloomberg, right, they were expecting a 0.2% contraction. Reuters, on the other hand, had more optimistic, but only expecting a 0.6% improvement. So in terms of that, but still the GDP for advanced estimates outperformed, grew about 0.7%. For the full year, if you look at GDP, full year forecast is about 0.5 to 2.5%. And we look at some of the economist surveys, I think some of the risks that has been put out is definitely the slowdown in external growth. A lot of hopes have been pinned on China's reopening and macro policy, but of course, China's GDP and some of the macro indicators that we have seen recently was not up to expectations. So a lot of focus will be on recent China policy developments to see how they can help, of course, China's property sector, how they can improve consumer spending, which was what the I think the world was banking on to see growth in I would say China's consumer segment after the reopening. So these are some of the things that are pinning down the growth. If you look at the GDP itself, right, for Singapore, coming back to it, if you look at the different sectors that we mentioned, right, manufacturing sector has continued to be a drag for second quarter. It shrink about 7 to 8% year on year, and also worsening from previous quarters. PMI itself, if you look at the manufacturing index, right, also been contractionary for a few months straight now. In particular, the electronics PMI has been down quite a bit. It is in contractionary territories. So local manufacturings, right, have, like I said, I think I mentioned briefly this, local manufacturing has been bracing for a more gloomy outlook going into second half. And of course, there's global uncertainties. And of course, the disruptions into the semiconductor supply chain also affected the electronics sector. Some of the listed companies that touches this segment, for example, Nanofilm, AEM, have seen drops in revenue, but also have issued profit warnings to say that there could be a drop in profit or a loss for first half. Of course, there is, but on a brighter note, I would say on a brighter note, the service sector still anchored the growth of Singapore's GDP. It actually picked up quite a bit of pace in the second quarter. Construction activity also has been rising.
Right. I think we do have quite a bit of time to fit in just one more question. So we'll just pick one last one. Yeah. So it's about with the higher interest rate, a number of REITs have are hitting the regulatory caps, and this has resulted in dilution of the investors. So then, how should investors position REITs exposures?
No, actually, I think that's a relevant. I would say it's a timely timely question. I know it stemmed from the recent announcement by Manulife REIT, right? So for some of the, I think putting it into, I will obviously put it into context, right, to understand what actually drove this. That if you look at, or you look at a stock itself, or you look at a REIT itself, the question is higher interest rates. Of course, that is one reason that could increase the regulatory, I would say the leverage ratio of a REIT. When we talk about regulatory cap, likely we're talking about the leverage ratio, which is your debt over your assets. Singapore has a cap of 50%. Many of the REITs have actually, most of the REITs actually have not hit that. Average across the sector is about 38% right now. Of course, Manulife announced that recently they've hit the max and went above the limit. I think important to understand is that interest rate is not the only reason why the your debt increase, your leverage ratio increase. It is a reason because with higher interest rate, your debt expense increases, meaning your total debt, meaning that your debt expenses increase, which means that your, I would say your distributable income that you can give to your shareholders will decrease, but it may not necessarily increase your leverage ratio, because by definition it is debt over assets or total debt. But with interest rates, right, it's just your interest rate expense increases. It doesn't increase your total debt unless you take on more debt. So that is what will change a leverage ratio. What will change a leverage ratio is, of course, like I said, you take on more debt, but it also changes if your asset value changes. So if you look at the ratio, right, if your value drops, then your leverage ratio as a whole will increase. So this is what happened in Manulife's case, unfortunately. So because of the devaluation of its assets in the US, which is mainly office assets, that's why the leverage ratio went above. This is a case that we have been seeing, I would say, in many of the REITs in the US because of the office assets. The work from home culture is still pretty prevalent in the US market compared to the Singapore market. So if you look at this, right, I would say the outlook for Singapore office, I would say rental, as well as the outlook has been pretty positive so far going into second half of the year. And some of the office rates over here are still pretty stable at the moment. Which is why I would say how I think part of the question is also, so just to give you a bit of context, right? And part of the question is also how should an investor position REIT exposures? Again, when you look at the performance of a REIT, right? Of course, this kind of changes, structural changes in a sub-segment is very important. There's also opportunities, however, if you look at some of the growth drivers of REITs. Number one is also we have seen performance for hospitality REITs still pretty strong, I would say, this year. If you look at the hotel REITs that we have, of course, because of the reopening. Second one is also Keppel DC data center has also been a key performing asset this year. But instead of just looking at this, right, it's also important to look at the management of the REIT. Because we don't want to just ignore the interest rate, I would say the interest rate impact on REITs, which is part of the question, right? If you look at interest rates, REITs has voiced out, many of the REITs has voiced out in their reports to say that yes, with increased interest rates, with inflation, the expenses have gone up, which is why what many of them are trying to do is also to actively manage this interest rate exposure. Actually, for REITs, right, on average in Singapore, 75% of their debt is based on fixed interest rates, meaning that they either entered directly into a fixed rate debt or they kind of hedged it to a fixed rate. So 75% of it is fixed, meaning that with an increase in interest rates, that exposure is still manageable. That is another key point to look at. And of course, there's other metrics that you should look at for a REIT. One is also you still look at debt, right? It's the interest coverage ratio. I don't think I want to go into that. That is also another regulatory cap put on REITs, interest coverage ratio. Other performance operational metrics that you should look at as well. I would say weighted average lease expiry, how many REITs have tenants locked in, what is their tenure, how much runway do they have with current tenants, what is the concentration of a tenant, do they take up a huge proportion of their rental revenue. So these are also key metrics I would say to look at. Yeah.
Right. Candice, actually, we have quite a lot of questions from the audience, right? So do you want to pick one question
I can
and...
take I can take probably one more, right? I see
Mm,
a question. Actually I see a few questions on liquidity. I think one is saying that the number of stocks with adequate liquidity has been shrinking. What is being done to increase liquidity for investors? I know as exchange, maybe I shouldn't be addressing this too directly as well, but it is something that we have heard from, I would say, investors throughout the years. I don't think it's, I would say, I think it's a perception to this. Liquidity by itself, you will see that there are certain gems in the Singapore market that have performed well. There has been a lot of what we say restructuring, like I said, from Keppel, Sembcorp, right? They have been doing transformations. But of course, Keppel, Sembcorp, these are huge names. They have concentrated liquidity in these stocks. But there are also smaller stocks that have been doing restructuring, business transformations. And with that, right, many of them, I would say, don't present themselves to the investors, which is why investors probably don't know about them, don't know about the change and their growth, and therefore are not aware of these stocks. So what we have been doing to increase liquidity for both investors and for the company is to profile this kind of companies that you may not have heard of, but are actually doing pretty well in the background. So we have this column called 10 in 10. This is a column by where we ask a company 10 questions about a company. For example, what is your business driver? How have you performed in the past year? Why did you do this transformation? We focus on small stocks like this on a weekly basis to talk about them, to profile them, and to talk about what they have been doing. So this gives them the chance to profile themselves to investors so that you know and look at this stock. So that is on, I would say, on the research side, what we have been doing, and we have definitely seen improvements in some of these companies recently. On the other side, right, in terms of the trading portion, there is also the what we call, I think I also mentioned this briefly, market makers and active traders. So from, like I said, the concept of fund flow, right, they are the ones that bridges the gap between retail investors and institutional investors. So they bridge the gap between the trades, and they would try to boost liquidity for the market. So this is exactly what that group of, I would say, that group of market makers are doing. Yeah. In terms of liquidity, right, yeah, it's also cyclical. I would say, I think my promise last point on this, it's also cyclical. We have seen strong liquidity during the COVID period. There's many active traders because of the movement. And of course, I think also because people are at home, that's why they kind of trade a bit more. But recently, we have also seen what we call investors are kind of sitting back and observing because we don't know. There's quite a bit of uncertainty in the market. So this is, you can actually see it in the fund flow activities as well, because retail flows have shrunk from first half last year compared to first half this year. And in terms of net flows, right, when we say shrunk, it's because that sitting on the fence, just looking at watching the market to know when to enter. So that is also something that we are looking out for. And once we get the market gets higher, I would say clarity on rates, on inflation, then we might see some of these flows coming back into the market again. Yeah.
Yep. Okay. Thanks for addressing most of the questions in detail, Candice. So, actually, due to the time constraint, right, I think we'll be just addressing all the other questions in via the email that the audience have registered for today's webinar. And yeah, here is the promo code. All you have to do is to email us at ps@saxomarkets.com with the promo code, and the first 10 people will walk away with our dog gifts, which you can collect it from our Saxo office, along with the $20 Comcred from Saxo as well. And for those of you who would like to rewatch the webinar, it will be uploaded on our webpage 3 days from now. And you can also follow us on our social media and subscribe to our YouTube channel, Saxo Markets Singapore. And you will stand a chance to win some of these dog gifts as well. And also, if you do have any sales inquiries or any feedback regarding the webinar tonight, please drop us a note via the feedback form when this session ends, or you can also drop us an email at ps@saxomarkets.com as well. Thank you, Candice, for conducting the webinar with us today. Thank you to the audience as well for your kind participation, and we hope that you have enjoyed today's webinar. Any last words from you, Candice?
No, thanks everyone for joining, and thanks also for the invite. Sadly, we don't have I think too much time to address all the questions in detail. Yeah, but thanks everyone, and have a good evening.
Yep. All right. Once again, thank you everyone for joining us today, and have a good night.